This set of slides is on perspectives on market behaviour and portfolio construction. Much of modern investment theory and practice is predicated on the efficient market hypothesis. However, the efficient market hypothesis is not universally accepted. When we're talking about efficient markets, we're talking about one in which prices adjust rapidly to the arrival of new information, and current prices contain all information about the security. Hence, if markets are efficient, each security should be correctly priced for the risk of the investment. And this is all traditional finance theory, efficient market hypothesis. So this graph shows you the reaction to a stock price in an efficient and inefficient market. So an efficient market is one in which the stock price is at a certain level, there's bad news about that particular company, and the stock price should be readjusted downwards based on that new information. Analysts should incorporate all information that is publicly and privately available, readjust the stock price, and trade at the lower level. That's an efficient market. An inefficient market may receive the news but overreact, forcing the price further down than what it should be, to bad news, and then revert back to the mean. Or another inefficient example of an inefficient market would be a delayed response to bad news. So the price gradually reverts to what the new valuation should be. There are three forms of efficient markets. The strongest form is where all public and private information is incorporated into prices. And from there we go to semi-strong form, which is where prices reflect all public information. And the weak form, efficient market hypothesis, where prices reflect all security market information. So the price and volume of securities traded. There have been challenges to this efficient market hypothesis. Some researchers claim violations of the weak form efficiency. The early evidence seemed to support weak form efficiency, but recently the pervasive momentum effect is a major anomaly. And violations of semi-strong form efficient market hypothesis is that there are a number of fundamental anomalies. For example, value stocks that outperform growth, small cap stocks that outperform large cap stocks. Some other anomalies include the January effect, where January stock returns are higher than any other month, the Monday effect, where stock prices tended to go down on Mondays, turn of the month effect, where stocks earn higher returns on the last day and the first 4 days of each month. They find that stock markets overreact to bad news, and the momentum effect. So these anomalies challenge the theory of efficient markets that traditional finance base their theories and fundamental analysis on. Behavioral finance models, needless to say, challenge these traditional finance concepts. There is no unified behavioral finance theory, but there are 4 models that have been proposed. So behavioral life cycle theory incorporates self-control bias and mental accounting and framing biases. So the self-control bias is where greater emphasis on current consumption than on future goals, i.e. we have problems with controlling ourselves and our spending currently. We're less able, or it's difficult because of our self-control issues, to set money aside for future consumption, and we prefer to spend it all now. Mental accounting is where different sources of wealth affect expenditure differently. Money treated as income is spent differently than money treated as an asset. So we have different pools of money in our head that have different purposes for expenditure. But finance and economics assume that, money is in aggregate, and is money spent from one pool of money is equally good spent from another pool of money. Framing bias is where different responses depend on how a question is asked or how it is framed. Another theory is the behavioral asset pricing model. So that's a variation of the traditional finance model of CAPM, or the capital asset pricing model. The traditional CAPM assumes that market prices are determined through an unbiased analysis of risk and return. But the behavioral asset pricing model allows for a certain amount of bias by adding a sentiment premium. The bias is incorporated by using the dispersion of analysts' forecasts as a proxy for sentiment. So when analysts are assessing their stocks and making a forecast, their own biases are included in their forecasts. So by using the dispersion of analysts' forecasts, we are capturing some bias. The greater the dispersion of analysts' forecasts, the greater the sentiment premium. Behavioral portfolio theory is another behavioral finance theory where investors hold a combination of nearly riskless assets and considerably riskier assets rather than a well-diversified portfolio, and structures portfolios in layers. Factors determining the allocation to layers include the importance of the goals, the required return, the utility function, access to information, and loss aversion. The correlation between layers is ignored, so it's not mean variance efficient. So in contrast to traditional finance, where Markowitz's portfolio theory used the real probability distribution, behavioral portfolio theory uses a probability-weighted function. In behavioral portfolio theory, investors construct their portfolios in layers, and expectations of returns and attitudes towards risk vary between the layers. The resulting portfolio may appear well diversified, but diversification is incidental to, and not necessarily an objective of, the portfolio construction. And the adaptive markets hypothesis incorporates the principles of evolution. Under the AMH, successful market participants apply rules of thumb, i.e. their experience or heuristics, until they no longer work and then adjust them. Those who cannot adapt do not survive. For example, pandas are extremely non-adaptable, eating only bamboo. This reduces the likelihood of pandas surviving in significant numbers outside of protected settings. In a financial example, let's say a company called Long-Term Capital Management is faced with increasing competition that use the same arbitrage techniques as it did. Rather than adapting and changing their techniques, this particular company increased leverage and ultimately faced the possibility of non-survival. So under the AMH, individuals act in their own self-interest. They make mistakes, they learn and adapt. Competition motivates adaptation and innovation, and natural selection and evolution determine market dynamics. So there are 5 implications. The relationship between risk and return is not stable. Active management may be successful by exploiting arbitrage opportunities. Any particular investment strategy will not consistently do well, but will have periods of superior and inferior performance. The ability to adapt and innovate is critical for survival, and survival is the essential objective.